Well, thank you very much for a very interesting talk.
You're welcome.
Kind of scary. One question, could you talk a little bit about radio programs, the news, talk radio, and how that's contributing to this whole scenario?
Things like that whip people up into a fervor. They get people extremely angry. And I don't know if you've ever read George Orwell's 1984, but they had a segment in there called the 2-minute hate. And the idea was you set up this straw man and you just whip people into this frenzy of hatred of this person that didn't even probably exist. But that's in order to make people more controllable. People who are angry and afraid are much more subject to external control, because it just pushes you right back into the emotional part of your brain and disconnects the thinking part on the whole. And that's a fundamentally unconstructive direction to take things. So I think the people who are doing this are really doing a profound disservice to the population. Because if you make people, if you get people into a mindset where they're going to play a blame game, they're so much more vulnerable to demagoguery and then repression, and then we will all suffer as a result. I'll let Aaron decide where the microphone goes.
I just like to, I saw a web posting on Zero Hedge this week, and it was a report from a ATM company that reported that they were no longer able to get physical currency from the 4 largest banks. And in fact, all this QE2 they're talking about, they're not printing any additional currency. I just wonder if you have any comments about that.
Basically, it is going to get much harder to get hold of cash. I mean, already, if you wanted to turn up at a bank and get even a few $1,000s in cash, they would expect several days' notice. They are going to make it more and more difficult. So getting hold of money is already harder than it once was. And it's only going to get harder from here. So it's something to bear in mind. However, if you do decide that you want to take out cash, if you try and take out more than a certain amount, then you will end up with a giant red flag next to your name, because the government would regard there being no legitimate reasons for doing that. So if you do want to take something out, then keep it below 10,000, because that's the limit that gets you flagged. And below that, let them think you have a gambling problem or something. They won't bother you for amounts below that. Above that, then you start getting into other categories of potential criminal behavior in their minds that will start to attract attention, and you don't want to be audited within an inch of your life. So be careful. But yeah, it is going to get harder to get hold of cash going forward, absolutely. But if people try and get everything all at once, then there are issues to do with that as well. So it's a balance between the two.
In my community, I was thinking about opening a new account with a new credit union. It was a small credit union. I went in and I said, okay, I'd like to learn about opening an account. And I said, how much cash, if I came in one day after work, how much cash would I be able to take out in cash? And she said, the daily limit is $500. Mm-hmm. I said, well, what if I wanted a lot of cash? The daily limit is $500.
Mm-hmm. Mm-hmm.
Hi, it's Emil speaking here. I follow your site. It's a daily journey for me. The first thing I do when I wake up is I go to your site, so it's fantastic. Thanks. I really appreciate it. I have about 10 questions, but I don't think I'll get to ask them all. But
well, we can talk about them later.
Well, one that really struck me here is that you said they made some, we came within 3 to 5 hours of having a nuclear meltdown in the financial industry in 2008, or the global banking system. What did they do to fix it, and why can't they do that again to extend this crisis happening a little bit further?
Well, it's not exactly clear what they did, because they did it behind closed doors. So basically what happens is if you get them all together and they all agree to not rock the boat, not have any one of them rock the boat, then you can keep things going for a little bit longer. It's really when you get a breakdown of that consensus, and it ends up being every man or every bank or whatever for himself. And essentially the derivatives market has a built-in meltdown mechanism through the CDS market, so credit default swaps, this would be. These are insurance contracts effectively. You can insure against the price of something falling, but in the CDS market, you don't actually have to own that thing to be allowed to buy insurance on it. So that's like me being able to take out fire insurance on your house, which would give me a potential incentive to have an accident with matches. So this is the kind of thing that can cause these banks to break ranks, because it may be in somebody's interest to force something to fail for profit. And that's the kind of thing that drives wedges between the sort of solidarity that can keep them in the extend and pretend phase. And it doesn't take very many wedges to get driven into that consensus before they start to just, dump each other's interests and go for their own. Because if they see their own interests diverging sharply from the interests of the group, then that group will break up. Right now, they realize that their interests lie in the whole maintaining extend and pretend together. But I think that will come under significant pressure once we see the rally end. Because rallies give you breathing time, because you get a resuspension of disbelief, you get a resurgence of confidence. It takes the pressure off. People are not beating down the doors of banks or whatever to try and extract assets at this point the way they were in March 2009. People were really starting to panic. The rally has seen an awful lot of people go back to sleep again. They just think, oh, well, all over, nothing to see here. And so that's taken the pressure off, and it's made a lot of things appear to work that would not work had the psychology of a rally not been in place. So rallies are very supportive of the actions of governments and central bankers. Almost no matter what they do, they seem to be reasonably successful. If they try the exact same thing when there is not that kind of supportive collective psychology, it'll fall flat on its face and they'll be blamed for it. So no matter what they do, it's not going to appear to work. So Hank Paulson, for instance, was trying super SIVs, structured investment vehicles and things, bad banks and good banks and all sorts of things he was talking about. Not one of them worked, because that was all prior to the rally. And this QE2 that people are talking about, I think is going to come into that category of things that are not going to have the support of a rally behind them as QE1 did, which made QE1 appear to work, appear to stabilize the situation. I think QE2 is going to fall flat on its face because it's not going to have that kind of supportive psychology behind it. So it's simply not going to work. But it is just more of the same. But it's not that quantitative easing worked. It's that for a while, anything would have worked, and then after that, nothing will. So.
I guess the second part of the question here, real quick, if this disaster unfolds as you say it or predict it will, is a new currency going to come into existence? And if so, will it be debt-based or will it be a real asset-based currency?
I think we're very likely to see new currencies come into existence, and I think they're going to try all sorts of things, and most of them are going to fail, which is going to be part of a tremendous period of upheaval. This is one of the reasons that I say that cash is not a long-term bet. That, if the price of goods and services does this, the risks to holding cash do that. One of the risks to holding cash is the reissuance of currency. Russia did that. However, it's not something that happens overnight, and I don't think it's anything likely to happen here anytime soon as it did in Russia. In Russia, the middle class didn't trust the banking system anyway. There was an enormous amount of money under the beds of the nation. They were trying to smoke it out by making people convert it from old currency into new currency. That's simply not the case here. Nobody keeps money under the bed, so to speak. And so there isn't anything to flush out. Most people are thoroughly credit dependent, and so I don't think you would see currency reissue for that reason. If you saw currency reissue here, I think it would be to dispossess foreigners, because there is an enormous number of American dollars held in other countries where it may be the de facto currency in those countries. If there is a currency reissue, those people will have no way to convert to the new currency. Their holdings will lose value 100% overnight, essentially. So for that reason, there could be a currency reissue. But it's not something that happens out of the blue overnight. So cash is the safest option. It's not perfectly safe. Nothing is perfectly safe, but cash is the safest option to ride out a deleveraging. Beyond a certain point, though, the risks to holding cash can be significant, so hence hard goods. Now, when they do try and reissue a currency, they may try new fiat currencies, which is essentially what the ruble was when they reissued that. So they might try new fiat currencies. People might try special drawing rights through the IMF. They could try gold-backed money or commodity-backed money. There are various different possibilities. A lot of people are calling for sound money, by which they mean gold-backed money, typically. Most of the people who are calling for that are actually pretty darn wealthy people, because the point of a gold-backed currency is to keep a really hard lid on the money supply. And the only people who really want that are the people who think they would then get some of it. But if there's not very much of it, because there's a really hard lid on it, ordinary people are not likely to see any of it. So ordinary people who are voting for a gold-backed money supply are a bit like turkeys voting for Christmas. because you may find yourself completely outside of the resulting monetary system, which is the way things have often worked in history, where actual money, gold coins, were things that passed around between very, very wealthy people. And ordinary people may have got the odd little crumb of something here and there, but mostly they ended up bartering, and they could not afford the services of other people. This is one of the first things to go, is the ability to afford the services of other people. So if you look at older societies, people had to do almost everything for themselves because they didn't have any money, so they couldn't afford to pay anyone else to do anything for them. And I think that's something people don't really think of enough. There's a place in Canada that they've set up as a historical village, and from 1862 they've set this up as. And they would say, well, there's the bakery and there's the dressmaker's shop. And they'd be saying, but the baker's not baking for you. He's baking for the military camp down the road. You're baking your own. And the dressmaker's not making anything for you. She's making something for the lady in the big house. You make your own. And so then that applies for all the kinds of services that would have existed at that point. So we have to think about money supply and how we would back a money supply by something that would give us enough of a money supply to cope with the number of people that we have. Gold is really not going to do it. And one of the reasons that we went from gold to bimetallism to ephemeral credit digits and everything else that's been an enormous broadening of the money supply was to cope with the scale of expansion. Partly the population expansion that we've seen in the last century, but also the expansion of the economy in general, the enormous increase in socioeconomic complexity. That can only function with a commensurate money supply. So basically, if we do not have a money supply that will allow that to function, then we can't have that kind of economy. So it's a question of how big a step backwards are we going to take. We would have to have a money supply that fitted with whatever level of socioeconomic complexity we were trying to have. Now, by putting it that way, I don't mean to imply that we actually have the kind of control to make those decisions. It's not a top-down thing, really. It'll be a bottom-up thing that will simply be something people try that will work out or not work out. We don't actually have the ability to control everything from the top down, decide what should be money, and simply impose it on a global economy. But effectively, if we're going to find something that works, it will be because we have a money supply that roughly fits the level of socioeconomic complexity that we can live with. And that's probably going to be drastically lower than we currently have. So a bit more than you might have been bargaining for is the question.
Hi, I'm Darlene DeHuty. I have a pretty simple question. If we're supposed to cash out of society, basically, sell stock, bond, real estate, and get all the cash, where are we supposed to keep it?
Well, what I tend to tell people is you need a certain amount of physical cash under your own control. But you wouldn't want to put all your eggs in that basket because there's some pretty obvious risks to doing that. What I tell people is if you can manage a year's worth, if you can't manage that, at least a few months' worth if you can, that covers you for interruptions of access to cash. But apart from that, if people have more than that, then I tend to suggest short-term treasury bills. You can buy things like that through Treasury Direct. So the shortest possible term, because then you're not dependent on the secondary market. The thing with longer term bonds is you have to, unless you want to wait 30 years, in which case government will be bankrupt anyway, you would have to sell them in advance of that into the secondary market. And if interest rates are going up, bond prices are going down, that is not a capital preservation strategy. If you hold short-term government bonds, that's not a long-term bet, but it's another way, it's a cash equivalent, it's a way of riding out a great deleveraging. The risk to do with that is that they might be converted to long-term and then defaulted on later. That's what Argentina did. But again, that doesn't happen overnight, and you're not dependent on the secondary market because the government simply owes you your money back in 30 days. You don't even have to roll these things over. You can just leave the money in the Treasury Direct account, in which case you're using the Treasury of the United States as your bank, and that will be standing a lot longer than the rest of the banking system. So again, it's not a long-term bet, but it's a way of riding out a deleveraging in a way where you should be as liquid as possible, where you can then get access to those funds as you need them. But it's not a no-risk scenario. There is no no-risk scenario. But it's a lower risk than most of the other things you could possibly do.
So I have a question based on a story in the New York Times this week. The Irish government announced, turns out we have double the debt we thought we had, and that our austerity measures were not going to actually address it. We're going to have to do something much more. And in the course of that story, it talked about how the Irish government was paying about 11.5% on its bonds, where the German government is paying 2.5%. And then it said, and this is the thing that really struck me, which I want to ask you about, is that there's a very small market for Irish government bonds, that any one trader could actually move the price of Irish government bonds because it's such a small market. So my question to you is, given the psychology aspect of what you've been talking about, is our fate really in the hands of one trader of Irish government bonds?
No, I don't think that many people really understand the system. So it's not that just anyone could go in and have that kind of effect. The people who are working in the bond market, though, are setting rates. And one of the major effects this is going to have, I think, is going to have a huge impact on the European Union. Because if you if you have a monetary union, yet all the different countries are paying radically different amounts on their bonds, this is extremely divisive. And besides that, you actually have a currency where you can tell where that currency was printed. So Germans, for instance, will only hold German euros. That is an enormous recipe for huge divisions. That means that the euro is not so much a single currency as a glorified currency peg. So what you're likely to find is speculators are going to drive wedges between European countries, partly on the bond yields, but partly on the value, the relative value of their euros. You could find, for instance, it's entirely possible that people might end up saying, well, you know, I'll take your Greek euros, but not 1 for 1, 2 for 1 maybe. And then you don't have a single currency anymore. And that is going to be a massive risk for Europe. There's sovereign debt default risk, which is huge. The entire European periphery is facing sovereign debt default. It's not just Ireland or Greece, it's the whole European periphery. So, and the center is trying to concentrate all the losses in the periphery to say, well, you people were greedy, so now you go and impose all these hideous austerity measures on your people to stay in the Eurozone. At some point, those measures are going to be such political suicide that I think these countries are going to vote by themselves to leave the Eurozone because the cost of staying there will simply be too high. So I think the Eurozone is going to, at the very least, get an awful lot smaller than it is at the moment. And the kind of uncertainty that this is going to introduce into the markets, I think you're going to get massive capital flight out of Europe, which is one of the reasons I think that the US will actually get propped up for a period of time, because capital flight out of the US is likely to end up, or out of Europe, is likely to end up here as a knee-jerk flight to safety into the reserve currency. And if you add to that the deflation of dollar-denominated debt, which, as people try to pay off dollar-denominated debt, of which there is more than any other kind, that creates demand for dollars as well. So I think that will actually see the US dollar significantly propped up over perhaps a year or two. So I think that the US may get a bit of a breather in comparison to what I think is going to happen to Europe. But I think Europe is going to be in for an enormous amount of pain. Speculators are very good at driving wedges between people, and there's such a history of conflict in Europe. I don't say this as a Eurosceptic. I love Europe. I'm European myself, and I love the idea of European unity and avoiding the conflicts that Europe has been plagued with for centuries. But I think during contractionary times, when there's not enough to go round, people tend to remember why they didn't like each other not so long ago, unfortunately. And I think that kind of dynamic is very likely to come back in spades. And that's just going to be a tragedy for modern Europe. I mean, I hate to think of that happening, I really do. Merely that I think it's going to happen does not mean I'm in any way advocating it or wanting it to happen, but I think it's coming.
We have time for one last question before people get to go use the restroom. Nicole, pick someone.
There's a hand over there.
Way in the back, okay.
Yeah, my name's Craig Weed from Berkeley. Got a question. You had mentioned where you thought we were at in terms of on that mania chart that we were going through the intermediate term rally off the March 2009 lows, and you pointed to approximately we're up in this area here on the counter rally. What do you think would actually trigger this crash that you expect to happen, this second coming of the Great Depression? Be Southern debt to collapse or a foreclosure gate type crisis we had, or
I don't
something
actually
of that
think it
nature?
needs a trigger because financial market moves are essentially endogenous. So what I do think we're going to see is things will tip over merely because they're Ponzi schemes, and Ponzi schemes are inherently self-limiting, but because human beings, as human beings, we are a rationalizing species more than a rational species. We like to look for causes for things. So I think when we see the credit markets turn, what people are going to do is look around them and see what's happening at the time and say, it must be because of that. So, I mean, it could be either of those things you just mentioned, or it could be something completely different. And I think foreclosure gate is a major possibility, is something that will be identified as a trigger, because you could actually have question marks over title to most of the properties in the country, because the entire securitization process was fraudulent. Most of the mortgage issuance was fraudulent. I mean, there is absolutely fraud at every single level of the mortgage system in the States over the last at least a decade. And there have been breaks of title in an enormous number of cases. So the government, I think, is going to try and do something about it. Everything it tries to do is probably going to make the situation worse and make people angrier. So it's entirely possible that that kind of dynamic could end up being blamed for a collapse of credit going forward. Equally, sovereign debt default risk in Europe is enormous. And you're starting to hear more about Ireland now. To start with, a while ago people were talking about Greece, and then they all went back to sleep again about Greece, even although it's in exactly the same position it was before. Now they're starting to notice that Ireland is in a terrible position, but there's also Spain and Portugal and England and the Netherlands and all of Eastern Europe. And people tend to either be complacent or panicking. Right now they're complacent with regard to most of these risks. These are huge systemic risks, but people are mostly unaware of them. But they become aware of them all of a sudden, and all of a sudden it's a cause for panic. They just switch from one mode to another. So I do think we're going to see a spiral of sovereign debt default risk and problems like that. So those two things are probably the two most likely things in my mind. The two things at the moment that one could predict as being things that would be rationalized as causes for the next phase. But it's entirely possible that it could be something else that one can't necessarily predict in advance, that could simply unfold out of the blue, and then people say, well, it's all the fault of that. But we really don't see so-called external events driving financial markets in the way that people would typically think. I mean, if you look at the markets over 9/11, for instance, for one thing, if you look at a market chart, you can't identify 9/11 on that chart. You can't see where that was. But if you were told where it was, you would have to conclude it was bullish, because 4 days afterwards the market took off. So all sorts of things that we would imagine would have a certain impact do not necessarily have that impact. So we do have to be very careful with looking for triggers and saying this happened or this is coming and this is going to have that effect. We can't necessarily say that in advance. And I think that's primarily because market moves are essentially endogenous. You have this constant tug of war between greed and fear. And my model of that is that it plays out as a fractal system, and that you can look at where you happen to be in that fractal system. And then you can time markets without knowing anything about the fundamentals whatsoever. And you wouldn't be able to do that if the fundamentals were driving the market. It's more a question, it's not that the market drives the fundamentals, but the market drives how fundamentals are perceived, which then feeds back into the system. So it's a complex interaction between the observer and the system in a positive feedback loop. which again is perhaps a little bit more than you bargained for when asking
Thank
the
you.
question.
Let's give Nicole some appreciation.